And we're back once again, options traders. Good morning, everyone. And I got an interesting comment from a trader recently saying that one of the benefits of long options, that is, options that you buy, is that you can't lose more than the amount that you paid, or what is called the premium. And that's a common belief, and it's mostly true, but there is a possibility that you can lose more than the amount that you paid. How is that possible? Well, let's go find out. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So let's start with long options. Remember, whenever you buy an option, the amount that you pay is called the premium. After all, options were born out of insurance theory, and if you buy an insurance policy, the price that you pay is the premium. Generally speaking, in all of the books that you read and literature on options, the premium is the most you can lose. But really, when they make that comment that the premium is the most you can lose, what they're really saying is that the option can't have negative value. And that's pretty much true with any financial asset. If you buy shares of stock, it can't fall below zero. If you buy a mutual fund, it can't fall below zero. There's this whole idea of limited liability for anything that you buy. And that's really what they mean when they say that an option can't have negative value. Again, a long option. But there is a case where you could lose more than the premium paid. And that has to do with this process called automatic exercise. It's technically called exercise by exception, and it only applies on expiration day. And the way that it works is this. If an option closes at least 1 cent in the money, it'll be automatically exercised. Now, if you happen to see that an option did go in the money and you don't want it exercised, you can call the broker and instruct them to not exercise. But that would require you to, let's say, opt out of it. Because the rule is if it's at least a penny in the money, it's going to get automatically exercised. Now, another little footnote here. Understand that every broker is allowed to set their own rules. The OCC allows instructions to be placed up to 5:30 p.m. Eastern Time, and most brokers will allow do not exercise instructions to be submitted up to that same time. But all brokers have the right to make rules stricter. So your broker might say, well, you had to call that in by 4:15 or by 4:30. So that's another little detail you can check out with your broker and find out what is the latest time that you can submit do not exercise instructions. Now, most brokers will also allow you to do a general statement or kind of a blanket statement and say, hey, I don't ever want any option automatically exercised on this account unless I instruct you otherwise. In other words, to opt into it. So if that's something you think you might be fearful of, then you might want to call the broker and see if they will allow you to put a permanent do not exercise instruction on the account. But those are the mechanics. That's the process that allows us to potentially lose more on an option than the amount paid. So let's go see how that's done with an example. Let's say the stock is, let's say, $99 near the close on expiration day. And you bought the $100 call. You paid $3 for it. Maybe you bought this call earlier in the day, last week, 6 months ago. It doesn't matter. That's the price that you paid, and it looks like it's now going to be out of the money. So let's say we've got maybe 15 minutes to go until the closing bell, again on expiration day. And so to save on commissions, you decide to not close the call. And so when you do, you're thinking, all right, well, maximum loss is $300. I paid $3 for the call, or $300 total. Remember, each contract controls 100 shares. So you're out $300, it's going to expire worthless, and that's the worst that can happen. But let's say the stock rallies to 100.01 or higher into the closing bell. And this can happen. Sometimes stocks can go off on a holy tear right into the close. So you walked away from your computer, let's say with whatever, half an hour, hour to go, 10 minutes to go, and the stock actually rallied. And the problem is that if you go through this auto exercise process, you are now going to be long 100 shares on Monday morning. Now remember, when you do this, you're going to pay the strike. The $100 call says this is the price that you're going to pay per share, no matter how high that stock price might rise. And so if you buy 100 shares at $100 a share, that is now a $10,000 investment. It's not a $300 investment. So maybe you see this happen and you think, okay, not a big deal. Why not just sell the shares on Monday morning? Well, the answer to that is maybe. You now have weekend risk. And so what can happen on Monday morning, kind of the worst case scenario, let's say that earnings are going to be announced before the opening bell. And what happened on Friday is that traders bid up the stock expecting positive results. That's why we saw that stock price rally into the closing bell. But as Murphy's Law would have it, it's a negative report, and let's say the stock falls 30%. I've seen this and worse several times. It does happen. And the problem with this is, remember, you are long the shares. So in this instance, you're down $3,000, not $300, far more than the amount that you paid for the option. Now that's an extreme example, but mathematically, any drop below $97 makes you lose more than $300. This was a $100 stock, you paid $3 for the option, so that's your break even, 100 minus 3. And so if it drops below 97, that's now going to put you into a situation where you are losing more than the premium paid. So the main thing to take from this video is that if you have an option that is slightly out of the money near the closing bell on expiration day, don't assume it can't end up in the money. Again, stocks can rally hard into the closing bell, especially if there's some type of a known news announcement. There's an FDA announcement or an earnings announcement, or it's just the Fed speaking, and this stock might really benefit if a certain announcement is made. It does happen. Now, if it turns out that you don't want to close the call and you're going to be away from your computer, if you're unsure that it might end up being in the money, well, call the broker and give do not exercise instructions. Now, if you do that, you will give up any potential intrinsic value. So let's say in this example, the stock rallied to 101. Well, if you had been there and noticed that going into the closing bell, you could have closed it and captured $100. Or if you wanted to take the risk of the auto exercise and sell the shares on Monday morning, you're now giving up that possibility. But that's a whole different set of risks. But just realize that auto exercise is a great example of why it's so important to understand all of the details when trading options. And once you understand auto exercise, you'll see that it is possible to lose more than the premium paid for any long option. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.